Good afternoon, everyone. Welcome to the Finance, Tax, and Audit Expert Exchange Gathering. This is a webinar to discuss the employee retention credit and how restaurants during this pandemic, during COVID-19, should know about this, should study the issue, and are probably eligible for some form of eligible wages credit during this time. We really appreciate the guests that we have on today. Everyone knows Michael Crittenden, who is from Covington and Burling. He is an expert on employment law and on this issue. This is, I believe, his fourth opportunity with us, so we are thrilled to have him on. But we also have two very special guests from the Treasury Department today. We have Tom West and Helen Morrison. They are fantastic, and they are all on this issue, providing information right from where it happens. I'm going to try to be quick with our time, but I'll remind everyone that this webinar is recorded. It will be recorded, it will be sent out, and you can register for it and watch it in your own time, because we want to make sure that you not only have the documents that are available on restaurantsact.com that go through the ERTC. You're aware of the IRS has a great FAQ on ERTC, but you can listen to this webinar as well, get some new guidance, and hear straight from the people that are making it happen for small businesses and restaurants all over the country. So Tom West is the Deputy Assistant Secretary for Domestic Business Tax, Office of Tax Policy. He went to school in Philadelphia and DC, meaning he had a couple of great food towns. But we are thrilled to have Tom and Helen with us today. And with that, I will hand it over to Tom.
Thanks so much, Aaron. Great to be here with everybody today. Thanks for the invitation. This is such an important topic, and it's really a timely topic. Of course, the administration has been doing everything it can to help small businesses. We know that some of the credit programs have been available for the last year since the CARES Act came out, but we're going to focus on some of the things that the American Rescue Plan did to expand these tax credits and talk about the employee retention credit fundamentally today. One thing before I got into the ERTC, I did want to remind folks of, because we have this great audience today, the administration has been talking a lot about the paid leave tax credit. That's another tax credit. It's not dissimilar to the employee retention credit that we're going to talk about today, in that it's a credit that you can take against your payroll taxes. But this is a credit that you can get as a small business owner for giving your employees paid time off. And in particular, what the administration has been talking about the last week, I don't know if you saw the president's speech, but giving employees paid time off to get vaccinated. That is a new feature that's been added to this program since the American Rescue Plan was enacted in March. And this is really critical in terms of doing everything we can to fight the virus right now. And so encouraging employers to give employees time off. And if you do give your employees time off, you can give them the entire day off. You can get up to $500 in tax credits for a day of wages that you pay your employee. So it's a really generous program. It's been expanded through September 30th of this year. And so that's another thing you should look into. If you're thinking about the employee retention credit, you're going through that paperwork. This is another thing. It's compatible with the employee retention credit. You can get both of them for different incentives. So I wanted to say that up front. Now let's dive into the employee retention credit. So I'm going to go and talk about an overview of the credit briefly, and then hand it off to some of my colleagues to talk about some of the details. But the employee retention credit is fundamentally available to employers, small employers, and small being defined as 500 or fewer full-time employees, who keep their employees on the payroll, despite the fact that they may have had disruptions to their business this past year. In particular, now in 2021, if you have, during any quarter of your year, you either have a full or partial shutdown of your business during the quarter, or if you experience a decline in receipts as compared to, for the same quarter, as compared to what your business was in 2019. If you have a greater than 20% reduction in gross receipts as for the quarter as compared to 2019, or for the quarter before. So there are a couple of different benchmarks to evaluate whether or not you've had a gross receipt reduction. But in either case, if you experience that as a business for the quarter, you are entitled to what are called employee retention credits. And you can take up to $7,000 per employee per quarter during 2021. Let me say that again. You can get a tax credit of up to $7,000 per employee per quarter. So that's up to $28,000 for the year in tax credits that are applied against your payroll tax. Prior to 2021 and some of the changes made by the rescue plan and other legislation, you may have heard about the employee retention credit being available in 2020. That's absolutely true. The employee retention credit was established by the CARES Act at the beginning of 2020, but the credit percentage was 50%, and you were capped at $10,000 in total for the year. So in 2021, this is a greatly expanded credit, again, up to 70% and capped out at $28,000. So a lot more businesses are kind of thinking about this now. In addition, in 2021, when the CARES Act first enacted the employee retention credit, it was mutually exclusive with the Paycheck Protection Program. So small businesses that could qualify for either one of these programs had to choose which one. And because of the convenience and because of the kind of popularity at the time of the Paycheck Protection Program, lots of small businesses opted to go with the Paycheck Protection Program and didn't take advantage of the employee retention credit. Well, the legislation changed in December, the law changed, and now a business can take advantage of both. They can take advantage of the employee retention credits retroactively for 2020, but more importantly, prospectively, even if you applied for a PPP loan in round 2 in 2021, you can also use the employee retention credits. Importantly, you cannot use you cannot claim the employee retention credit for those wages that you paid using PPP proceeds. So there is still a distinction that you have to keep in mind, and you still have to keep track of what proceeds and the source of funds that you're paying your employees with. But there's lots of businesses out there, maybe yours, where you still have payroll costs in excess of what your PPP loan is going to fund. And so you should be thinking about employee retention credits if you otherwise qualify. I think big picture, that's what I wanted to talk about. In terms of eligible employers, again, in 2020, eligible employers were smaller. In 2021, it's employers who have 500 or fewer full-time employees who are going to be automatically eligible for the ERC. For bigger employees, while they might still be eligible to claim employee retention credits, those credits are only available for employees who they are paying essentially not to work. For smaller businesses of 500 or fewer employees, the employee retention credit is available on any wages that you're paying your full-time employees. So I'm going to throw it to my colleague, Helen Morrison, and she's going to get into some more of the details about how businesses go about claiming these credits.
Thanks, Tom. One thing I should mention also, when you say that the credit is available for those employers with 500 or fewer employees for wages that are paid, we should also mention that the credit is also available for or includes allocable healthcare expenses. So that is in addition to the $7,000 per employee per quarter for 2021, and that's I think many employers do provide healthcare costs and expenses, and so I wanted to make certain that that was clear. Clearly, everyone on this call will be interested in how you claim the credit. In fact, we've already received some questions about the timing of receiving the payments for the credit if you file an amended return. But let me begin by saying, with the basic rules, that the employee retention credit is a credit against the employer share of employment taxes, either the employer share of the Social Security tax as it applied for 2020 and the first quarter of 2021, or for the last 3 quarters of 2021, it's a credit against the employer's share of the Medicare tax. The credit, as a consequence, because it is a credit against employment taxes, the credit generally is claimed when the eligible employer, and Tom defined who the eligible employers are. You have to be an employer who either experienced a full or partial suspension of business operations as due to a governmental order that related to COVID-19, or had the significant decline or a reduction. At this point, it's just a 20% decline in gross receipts. But if you are an employer that falls into that category, you could claim the credit generally by filing the quarterly 941, where you report wages and employment taxes. But there are 2 very important characteristics of this credit. The credit is referred to as a refundable credit and also an advanceable credit. So what do I mean by that? Well, a refundable credit, it means that it is a credit that the employer is entitled to, and even if the credit amount exceeds the amount of the employer share of the Medicare tax if you're filing for the last 3 quarters of 2021. So even though it's a credit against the employment taxes, the employer, because it's refundable, the employer is entitled to payment of the full amount of the credit. That's what it means for the credit to be treated as refundable. The second point I will make is that this credit is advanceable. Now, the terms of when it's able to be advanced have changed with the American Rescue Plan, but let me explain generally that for a business with 500 or fewer employees, that business is eligible to receive an advance of the credit in anticipation of filing the quarterly employment tax returns. The advance can be received in one of 2 ways. First of all, the first thing that employers should do who are entitled to the credit is to retain the deposits for the employment taxes. And by that I mean the federal income tax withholding and the employer and employee share of the FICA or employment taxes that would be paid, and can retain those up to the amount of the credit that is anticipated to be claimed. If that the share of or the employer's deposits are not sufficient to satisfy the amount of the credit, the employer can also file for an advance by filing the Form 7200. And by filing the Form 7200, the employer would be paid directly for the amount of the credit that is due, or the amount that was not retained with the deposits that are withheld and not deposited, but the excess amount could then be paid directly after filing the Form 7200. I should mention that the American Rescue Plan does put a limit on the amount that can be advanced, but that limit is 70% of wages in 2019. So generally, I think that most employers should still be able, most employers who come within that, the limit, the 500 or fewer full-time employees should be eligible to receive a full advance of the credit that they anticipate to claim. It is important, as Tom mentioned, that at the law that was passed at the end of 2020 did provide that an employer is entitled to the employee retention credit, even if that employer received a PPP loan. Prior to that change in law, many of you who received the PPP loan, and I think most of you, if you were in a position of trying to decide whether you're going to receive the credit versus a PPP loan, would made the decision to seek and obtain the PPP loan, because that's, if you use the PPP loan to pay wages or other eligible expenses, then the loan will ultimately be forgiven, which was a very favorable benefit. At this point, employers are eligible to receive both the PPP loan, and even if that loan is forgiven, to still claim the credit provided that the wages that are reported for purposes of obtaining the forgiveness of the loan are not the wages against which you are claiming the credit. So many of you will say, well, how do I do that? Because I did not claim the credit in 2020. I did receive a PPP loan. Now I want to go back and seek the benefit of the credit. You can do that by filing an amended 941, the amended quarterly tax, employment tax returns. That's on the form 941X. And by filing the 941X, claim the credit that you would be entitled to. So let me make two last technical points, and then I'll turn it over to Mike. I'll make two technical points, and then I also wanted to mention the guidance that we have issued and guidance that we plan to issue in the near future. So first of all, let me mention that if you claim the credit, there is a rule that says that you are not entitled to claim a deduction for the portion of the wages against which the credit was claimed. So if you're going back and claiming the credit on an amended return, you would have to take into account the deduction disallowance for those wages. And then finally, I know that there's some very favorable benefits that were passed, both the PPP loan I've already mentioned. You can't double up on reporting wages to receive the forgiveness of the PPP loan and also claim the credit. So you have to treat those, the credit on wages different, they're different wages than the wages that are utilized for purposes of obtaining that forgiveness. And in addition, there's some other provisions. In particular, there is a provision that says that we need to coordinate the rule. I know some of you may be operating under the restaurant revitalization grants, that we will need to coordinate when we issue guidance, as well as some other tax benefits that the statute assures that you won't be doubling up on benefits. So I did want to mention that there are some very favorable benefits that were enacted with the American Rescue Plan, but you want to be certain that you are taking advantage of the grant or benefit that is most beneficial to your business. So let me conclude my comments by indicating that we did issue a notice that focused on the 2020 rules, both the amended rules as well as the former rules. That notice, it's notice 2021-20, it incorporates the FAQs that we issued, plus includes some amendments that were updated for changes in the law. And then after that, we issued notice 2021-23 that addresses some of the rules that apply for 2021. And we are in the process of working on and hoping to have issued relatively soon an additional notice that will provide more detailed rules on the application of the credit, specifically as it applies for the wages that are paid during 2021. So let me conclude there, and Mike, turn it over to you. I know that there's a number of specific questions that the group has here, and we'll be happy to answer questions, or you can provide your sage comments about the application of the rules and the work you're doing with your own clients.
So thanks, Helen, and thanks, Tom. I appreciate you taking the time to join us today for this presentation. I have a few comments, but I don't want to spend too long talking about the credit in general and its how it operates. For those of you who are on the last call, it would just be a repeat. If you were not on the last call, it was recorded. It is available. My understanding is you can get it from the NRA. So please reach out and ask for it if you haven't seen it. I think it'll be a better use of everyone's time if we focus on the questions that a lot of you have now and are struggling with. And if it makes you feel better, this is an area where I practice every day. I don't run a restaurant. If I did, I'm fairly confident it wouldn't last. But I work in this area all the time. And I'm still struggling with a lot of questions with regard to the employee retention credit, having been advising on it for over a year now. And so I'm going to just throw out some of the issues that I'm struggling with, some of the questions that we've seen before the call started from folks. It looks like we have about 70 questions already since the call started as well. Some of those touch on things that we were asked before, but some of them are new and different. And we'll try to get to those as we can. I do want to caution that I'm speaking generally here. I'm talking generally about my view of what the law means. I'm not providing specific guidance or instruction to any of you regarding what you should do on your tax returns. I would highly recommend you consult with your tax advisors about this. This is somewhat complicated stuff, and it is there are lots of areas to make footfalls. So I think, everyone here, Tom and Helen, are, speaking on their own behalf, and you should rely on the published guidance that's available in coming to your decision. But we want to do what we can to help and provide sort of some general thoughts. So I wanted to start with eligibility, because eligibility seems like the first question that everyone has to answer. There were a couple things I just wanted to touch on. First, on the 500 employee threshold, which is a really important point because the credit is much, much more generous for employers with fewer than 500 full-time employees this year, and fewer than 100 or 100 or fewer last year. And there has been a lot of discussion about whether or not, and we discussed this on the last call as well, that test is a test of full-time employees or a test of full-time equivalents. And I think for those of us who advise on this, that question has largely been driven by a footnote in the Joint Tax Committee Blue Book on the CARES Act that suggested that it is a full-time employee equivalent test. The IRS, to its credit, I think came to the right answer. And in the notice 2021-20 and also in the original FAQs, relied on its guidance under Section 4980 to say that the statute says full-time employees, and it means full-time employees. Now, there is a full-time equivalent employee standard under Section 4980, which is the Affordable Care Act test for determining whether or not an employer is an applicable large employer that's required to provide health insurance. But it is only for that purpose, and that's not the purpose we're using it for here. And so I think the correct answer is that is a full-time employee test. It's not an equivalency test. The notice and the FAQs all indicate that you count the number of full-time employees that you have in each month of 2019. You add up the number from each month and you divide by 12 to get the average, and that is the number you're targeting for the bogey. Tom, Helen, I don't know if you want to comment on that, if you have anything you want to add.
Yeah, I guess the only thing I would add, and I'm not certain if you said this, Mike, but I did see in the Q&As the question was asked whether that test applies on an aggregated basis, and it does. The statute and our guidance provides that you would look to all entities that are treated as a single employer under the control group rules. And those rules are basically the parent subsidiary rule or the brother sister rule. Some of the aggregation rules can get a little complicated, but you do have to calculate the 500 or fewer, as well as some of the other tests that are applicable on an aggregated basis.
That is an excellent point. That is something that we've definitely struggled with in some applications, because that test, if any of you on the line claim the work opportunity tax credit, that is the basis for the aggregation rule that's used here. So it's broader than most aggregation rules in the code. But if you're claiming that credit, then that should be helpful in figuring out who's included and who's not. I know there was also some questions about the effect of acquisitions on that test. Do you have anything to add on that?
That is something that is under consideration. We have provided some FAQs on M&A transactions. They specifically applied in the context of the PPP loans. that those rules really are no longer applicable because, as we have said, an employer who received a PPP loan is not precluded from obtaining the credit. It's a fairly complicated set of questions we've received around M&A. So as with many things, it's going to depend on your facts and the time at which the employer is acquired and when you are testing, the decline in gross receipts. But for purposes of the number of employees, it is something that it's under consideration. We will have to, decide whether it's a guidance that we will provide, but it will be some challenging guidance because it's so fact specific.
Yeah, we're trying to get out as much guidance as possible on these, but also keeping in mind, given, we want to focus on the most widely applicable guidance too. And I appreciate that there has been M&A activity in lots of spaces over the last year, but in terms of small businesses who we think really need this help, I think there's probably a little bit less. And the bigger businesses can come to you, Mike, when they have M&A transactions. And
then I can scratch my head and look confused. So one of the other issues that I'm just going to throw out there and see if you have any thoughts. For the gross receipts test, originally this wasn't an issue because if you had a PPP loan, you couldn't receive the employee retention credit. Now, with the eligibility for the credit being restored by the CAA, there is a question about whether or not the forgiveness of a PPP loan itself constitutes gross receipts. And that's because, as I'm sure you know, under Section 448, which defines gross receipts in the regulations, it's rather broad, and it includes non-taxable income. And so, although there is an exclusion from income or a cancellation of indebtedness income related to the forgiveness of the PPP loan, it's not entirely clear that it's not gross receipts. But at the same time, it does seem a bit odd that it would be included and potentially preclude you from being eligible for the credit when there was a specific statutory intent to make you eligible. Is that something that IRS or Treasury has given any thought to, or do you have any thoughts?
I mean, we've certainly given thought to it, and obviously the way that these different pieces of legislation have kind of stacked on top of each other and had interactions that are both retroactive and prospective, and some anticipated consequences, some very much unanticipated consequences. This is an important one. We have heard about it. We've been thinking about it. I expect we will provide taxpayers some guidance in the relatively near future on this. Again, this is something that I think it affects, a segment of PPP borrowers out there, absolutely. And on the margins, we understand this could make a difference. So it is something we want to help answer for taxpayers. It's just not been at the top of the line. But I do think we are going to answer that question.
Okay. That would be helpful. That's great to know. Switching to the other eligibility test, and I want to make clear, because I think there was a question that indicated some potential confusion here. There are two eligibility tests for the employee retention credit. One is related to a significant decline in gross receipts, which was more than 50% in 2020 and more than 20% in 2021. The other is a full or partial suspension of your trade or business due to governmental order. And those are separate tests. You don't have to meet both tests if you're subject to a governmental order resulting in a full or partial suspension. For example, I know there are some restaurants out there who managed to pivot very successfully to delivery and carry out and curbside rather quickly. And so they no longer have inside dining. Or no longer did in 2020 when we may be figuring out the credits, so they may have gotten a PPP loan, and now we're looking back. But now they didn't hit that revenue reduction because they were so successful in pivoting, but they did have a partial suspension. Or arguably had a partial suspension. One of the questions that I've been struggling with a bit is how to determine whether or not you satisfy the nominal effect and nominal portion standards. And there's a safe harbor in the notice 2021-20, and it is a safe harbor. It's not a standard that has to be met. That a nominal effect is an order that affects your ability to provide goods and services to your customers by more than 10%, and a partial suspension is a suspension that affects, more than a nominal portion of your business. And that's more than a portion of your business that is more than 10% of the hours of service performed in the business as a whole, or more than 10% of the revenue from the trade or business as a whole. And so in the example I gave, where you have a business that successfully pivoted, but there's no doubt there's a government order that has suspended their inside dining, which perhaps accounted for 80% of their business pre-pandemic. But now it accounts for, or during sometime in 2020, accounted for none of its business because it was suspended fully, or maybe it was limited at 25% occupancy or something like that. But then, their takeout sales were much higher. Maybe they didn't even offer takeout before, but they pivoted. How do those tests apply? Or do you have any thoughts about how those tests might apply in a circumstance like that?
Well, let me jump in by giving starting off with a very unsatisfactory response, that this is very much a facts and circumstances test. So a couple things. I do want to emphasize that the full or partial shutdown has to be the consequence of a governmental order. It can't just be a decision by the business to even to comply with best practices or the CDC. It is in response to a governmental order. And then you need to look at whether there has been, if you're complying with the safe harbor, and it is just a safe harbor, other facts and circumstances may apply, whether more than a nominal portion of, and I emphasize this, of the trade or business. And trade or business, for those of us in the tax world, know that trade or business, you can have a single entity that may have multiple trade or businesses, or you may have multiple entities that are in the same trade or business. But you need to look at the trade or business and then aggregate all of the entities within that trade or business before determining whether the single location that was that entity, that location that was shut down partially or even fully by a governmental order, whether that particular location as part of the overall trade or business is more than the 10% threshold to be treated as causing the overall aggregated trade or business to be in be in the circumstance that there was a partial suspension of operations. So it really, I'll just go back to my initial comment that it's very much a facts and circumstances test, but you do need to look at the trade or business overall and assess whether, any portion of the business of that trade or business constitutes more than a nominal portion of the business.
Okay. I'm thinking about what that means. There's a lot to unpack there.
Yeah. Well, I think a simple answer may be one single location, and maybe if it's a dominant location, it may very well be, cause the entire, even if there's multiple locations, may mean that there is more than a nominal impact on your business. But another circumstance where you have, businesses or locations throughout the country, they're all within the same trade or business, and it's a very small portion of the business that doesn't rise to the level of 10% of gross receipts or 10% of the hours, then in that circumstance, it may not be treated as more than a nominal portion.
So let me ask a slight variation on that builds off what you just said. If you have multiple locations and some of them are subject to governmental orders, and so that there is the orders themselves would not rise to a nominal portion, But the original FAQs, and I think in the notice, it still says that you can adopt those guidelines sort of across the trader business. And it's not clear whether it's just an example or it's a requirement, but it talks about CDC standards and guidelines. And so one question would be if the order itself would not affect more than a nominal portion of the business, assuming that we're applying a 10% standard, as opposed to just a safe harbor. But then you apply that more broadly across your whole trader business to reflect CDC guidelines, or to make sure you're treating all your employees equally. Do I measure the nominal effect and nominal portion test based on only where the order is in place, or where I'm applying that order more broadly across the business, as I seem to be allowed to do under the FAQs?
So this may be a good time to say that these are my personal views and not those of the government, but
I tried to give that disclaimer for you earlier.
There is, you are absolutely correct that there is, there was an FAQ, and that FAQ was incorporated into the notice, and is exactly your fact pattern, where one location, it happens to be a retail business, not a restaurant, but it could apply equally to a restaurant with multiple locations. And there's a governmental order that, that is imposed on the retail's particular location. I think that what the facts of that, that Q&A in the notice would indicate is that the employer is applying that governmental order in order to have a consistent rule across its business. And as a consequence of applying that rule consistently and also consistent with CDC guidelines, the conclusion of the example is that the business itself would be treated as being subject to a full or partial suspension. So I think if you have that fact pattern and you are in one location subject to a governmental order, and you're a business that wants to have consistency throughout all of your locations, I think that in that circumstance, you would, consistent with the guidance we have in the notice, that you would be able to make an argument that it is more than a nominal effect on your business because you're applying it so broadly.
Thanks for that. I appreciate that. Let's move on from eligibility and talk about the, I don't know, we'll say the 1,000-pound gorilla that's in the room. And that is probably half the questions that we've seen relate to the treatment of tips as qualified wages. Now, and Lisa Haffer and I were on a call with this group, I guess it was about a month and a half ago, perhaps, and we discussed this. And since then, I've been inundated by emails from accountants and restaurant owners and advisors asking about the conclusion that Lisa and I both reached, that tips are not qualified wages because they are not paid by customers. And some of these particularly the accounting firms, have had some detailed ideas about how that might not be the case. And they point to a deeming rule that exists under Section 3121Q, that they're deemed to be paid by the employer for purposes of collection of the Social Security tax and the application of the Social Security tax. Neither Lisa nor I have changed our view on that, but we do acknowledge that there is some uncertainty there. And I don't think the IRS has issued any guidance one way or the other. But I do think that, Lisa, I believe, is still advising clients, and I know I am, that unless and until the IRS issues guidance saying that tips are qualified wages, we continue to believe that they're not, and we would not advise that you take that position. It's an area where we both tend to be, I guess you could say, conservative or careful, but that's what we think is the best interpretation of the statute, which does not mean that the IRS won't disagree with me. The IRS has certainly been known to disagree with me before on many issues, usually not in ways that help my clients, but sometimes I suppose that could happen too. So I don't know if you want to weigh in on that, or just, I know that's not very satisfying for people who are looking for an answer, because I don't think there is a clear answer at this point.
Well, I think what I can say on this point is that we have heard the question, and the guidance that we've issued is that qualified wages are wages that are paid by the employer, but are wages under 3121A, which are FICA wages. And as you know, Mike, tips are treated as FICA wages. So it is something that we are looking at. As I mentioned, at the end of my opening comments, we are working on guidance, and I think our hope is that we would provide some more formal guidance on this particular issue when we issue that guidance.
So I do think that one thing worth pointing out is that to the extent of you have any banquets or anything like that, is that service charges, I think, clearly are qualified wages. So if you have a service charge that you put on a bill that is charged to a customer, or large party charges, most of my clients have abandoned that, but if you still have a policy where you add 18% to parties of 6 or more, and then those service charges that are paid to the servers are qualified wages, but they're not tips, and so they are not they wouldn't that would affect your ability to claim the 45B credit with respect to them. So I wanted to talk some more about the interplay between the PPP and the ERTC or ERC, because I think that is a key point. And Tom and Helen, I think, have done a great job so far of teeing that issue up. But I really want to emphasize a couple of points that I've seen over and over again in the questions. First, there is no rule that precludes a business from claiming both the PPP forgiveness, so basing forgiveness of the loan, and the ERC based on the same period of time or with respect to wages paid to the same employee. The only requirement is that the wages not be used twice. So you can't use the same dollar of wages to get forgiveness of a PPP loan and to get the employee retention credit. But you can use them together in the same quarter. And there are lots of examples where that might apply. So for example, you might have an employee, particularly if you're a larger restaurant chain, you might have managers, regional managers, something like that, that earn over $100,000 annualized. And so, or very successful servers in high-end restaurants, for example, might, if tips are included. And so based on that, you might be able to claim the credits with respect to parts that are not payroll costs. More likely, there are payroll costs that are not wages. So there are, for example, employer contributions to retirement plans are payroll costs for purposes of PPP loan and forgiveness, but they are not qualified wages for purposes of the employee retention credit. And so there are ways to claim them sort of simultaneously on different dollars. And so the issue that a lot of clients and restaurants I've seen have had is that back last year before the CAA passed, you couldn't claim both. And so a lot of banks and some advisors advised to just use wages to seek forgiveness of the PPP loan because it was easy. You had the form 941 and it had all the wages on it. You just used it and you were done. Unfortunately, the IRS in Notice 2021-20 has indicated that if you used wages to seek forgiveness, you can't sort of retroactively use other expenses that you would have been able to use to seek forgiveness. So what you put on the form, you're kind of stuck with. Now, if you included expenses on the form that you didn't need, so you put down all your wages and you put down other expenses like mortgage, interest, rent, utilities, things like that that were eligible for forgiveness, you can reclaim the qualified wages that you put on the form and use them for the employee retention credit if you can document that the amounts on the form were on the application for forgiveness form were sufficient to get full forgiveness without using those dollars. If you have not yet received forgiveness, you could try speaking with your bank and see if you could amend the application for forgiveness. I don't know if they would allow that or not. if you've already received forgiveness, though, I think you're limited to trying to figure out if you included more amounts than you needed to on the form. If you haven't yet submitted an application for forgiveness, then I think you want to really focus on, to the extent possible, using non-payroll costs for forgiveness. So you're going to use utilities, business software, and it's important to remember that the legislation subsequent to the CARES Act also expanded the types of expenses that can be used for forgiveness to include, among other things, the cost of goods essential to operating your business, if the purchase order or contract was in place before your covered period. But with respect to perishable goods, which a lot of you probably buy a lot of, also purchases during the covered period are eligible for forgiveness. So this is a huge benefit. So that's going to give you 40% forgiveness based on those costs. And then you want to focus your wage forgiveness, your payroll costs, to the extent possible on those non-qualified wage payroll costs, like employer contributions, retirement plans. I think that's sort of the strategy to maximize your ability to take advantage of both programs. I don't know if Tom or Helen, if you want to add anything to that.
I thought I was writing down what you were saying when you started, Mike. I thought it was going to be a question, and then it turned into that, which is okay. I think I don't disagree with anything you said, really. I don't think we have put out any guidance kind of getting into the granular thin slicing of some of the kinds of wages you talked about. But I do, in my mind anyway, and this is not an official position, in my mind it's a dollar by dollar thing. Like, if you can attribute the dollar of wages to PPP, but then you have a dollar of qualified retirement associated with some of the same wages, that is not being covered by ERC. I think that's probably okay. In terms of some of the retroactive nuance that you were talking about, we're certainly aware of that, and aware that employers at the time that they were applying for PPP last year, before the legislation changed, we've heard some of the kind of complaints that, we might have done things differently. I think the IRS is really constrained in what they can do retroactively in some of those cases. But that's what I'd say. Helen, I don't know if you.
Well, the one comment that I will make, and you're correct that we did address this point in Notice 2021-20, and there are several examples. One example that I will point out is that if the employer only put down wages in support of the forgiveness of the loan, but the wages exceeded the amount that was required, that any amount in excess of what was needed for the forgiveness is certainly available for claiming the employee retention credit. So the mere fact that you reported the wages on the form that is submitted to the Small Business Association for Small Business Administration for obtaining the forgiveness does not preclude you from receiving the employee retention credit.
Right. So any amount that's on the form that you don't need, you can use. But if you only put down the amount that was needed, those funds are lost, even though you might have had other costs you could have put down.
Right.
So the next topic I wanted to talk about, and then we'll jump for the last few minutes into some of the questions that maybe Aaron can bring up from the Q&A today, relates to whether or not wages paid to a business owner are eligible for the employee retention credit. I don't know if this is something that you've considered or thought about. I haven't seen any guidance on it. I have a view, and it's a bit complicated, and I don't want to spend a lot of time detailing the statutory analysis of how I get there, but essentially, I get to the position that generally they're probably not, and that's because the rules under Section 51 disqualify individuals who are related to a 50% shareholder and a corporate taxpayer, as well as the taxpayer themselves. So if you're like a DE and a single member LLC, the owner themselves would be the taxpayer in that case. And the reason I get there is because you have to apply the constructive ownership rules under 267C, which in many cases is going to make someone else be treated as the shareholder as well. And then that person is going to be related to the person who is to whom ownership is constructively attributed. I don't know if you have thoughts on that or if you've considered the issue. It's not something that normally comes up in the work opportunity tax credit, which is where these rules come from. So it's easy to see why it hasn't been addressed before, but now it sort of matters more.
This question is, probably the second most question that we have received. We are working on guidance. I should point out that the credit is not available to a self-employed individual. So if you are an owner that is in a flow-through, it would not be eligible for the distribution to you as the owner. The other question, though, is whether it is available to wages paid to a spouse or other related individual. And that's a bit more of a complicated question, and it depends on the type of corporate or type of business entity that you operate in, and also the relationship to the individual who is employed by the business. So look for future guidance on that. We know that it's a question that we need to answer, but Mike, I thought your analysis was helpful.
So I'm going to throw it back to Aaron now, so he can throw out a few questions from the Q&A today to try to get through the rest of the hour.
And thank you again, Mike, and thank you, Helen and Tom. That was fantastic. I think for those who, the only reason why I wasn't answering them is because you're asking very good questions that I don't want to answer in an incorrect way. So again, the guidance that we were talking about on the restaurantsact.com, we have a link. It's at the top of the resources. That is an ERTC fact sheet. It's 6 pages. And probably most importantly, it links to the 2 last pieces of guidance issued from the IRS, from the Treasury Department, on how to claim the credit in 2020, which was issued on March 1st, and then how to claim the credit in the first 2 calendar quarters of this year. So those are probably the 2 most impactful documents that you can access and make sure you have at your disposal. A couple of questions to Helen and Tom. Does an employee have to be currently working with the restaurant on the day that the restaurant submits either the ERTC documentation or the 941X form?
So this is like, you're submitting for maybe an employee who quit or was terminated. I think you can still do that. I mean, I don't think there's a limit. Helen, correct me if I'm wrong.
Yeah, if you're submitting for wages that were paid in a prior period, either a prior quarter or even during that quarter, as long as the wages were paid, if you were subject to a partial shutdown, that they were paid during that period of time, or if it's a substantial reduction in gross receipts, it's during that quarter. Those wages would be eligible, if it meets the other requirements, would be eligible for the credit. Your question seemed to ask about termination or severance benefits, and we did issue guidance on that, in the context of a severance payment, that the severance payment is not eligible for the credit. And I think I saw one of the questions asked about that.
Right, it's about retention, right? It's about a retention credit. That's why we have this program available. It's called an employee
retention credit. That's a good point.
You're right, exactly. So for that question, because I saw it a few different times, if you paid the qualified wages during the calendar quarter where you are applying for the ERTC, that employee doesn't still need to be with you on the day you submit the documentation.
As long as they were employed and the wages were paid for services, if you're providing them for services, or that they, as an employee, if you're over 500 employees and they were just not working, but in an employment capacity, right, they would count.
Right. And another question, so I think for 2020, when we're balancing PPP, and I just wanted to get back to this because PPP has been such an important part of restaurant livelihoods over the past 13 months. There's also a Treasury program that they partnered on with SBA, but Treasury has such a leading role in that as well. Going back into 2020 and finding in a calendar quarter is restaurants can do that because PPP generally ended by September under your covered period. So you generally have Q4 of 2020 as an eligible ERTC quarter. But when restaurants are balancing that with a 24-week covered period of PPP second draw, so the question is, how do you chop up a calendar quarter if you are starting to use payroll for, let's say, March of 2020, and you're going to use PPP for that quarter or use payroll for that quarter? Does that mean that you would say, I can take ERTC for January and February, but not March? Or can I not take ERTC for any part of a calendar quarter where I use PPP for payroll? So just thinking about a calendar month, a calendar quarter, 3 months. If I use PPP for one of those months, like March 2021, does that mean I cannot use ERTC for January or February 2021?
No, I mean, depending on your circumstance, whether you are in the circumstance with a substantial decline, you would look to the wages for the full portion of the quarter. And if your wages exceed the amount of wages for that quarter that were being reported or will be reported for the forgiveness of the PPP loan, there's really no ordering. You just need to be certain that you are not reporting the same wages to receive the forgiveness of the loan as you are for claiming the credit for the quarter.
Okay, great. So a restaurant can slice it up. As long as you're eligible for everything else, you can take the credit for January and February for those wages while making your payroll in March with PPP funds. And I'll also remind people that you can have 40% of your PPP loan spent on non-payroll costs. So if there's a way to make it more elegant and more easier for you to do ERTC and PPP, you can do 40% of your PPP loans on non-payroll costs. And we're hitting up on our time right now, but there are two. So because we're talking about time, there are two timing and process questions that I wanted to ask. Number one, if a restaurant did file they did file for ERTC, there's a question coming up. How long is it going to take for me to receive these tax credits? Their liquidity is very low. How long is it going to take to receive a tax credit under normal operating expectations? And then the second thing is always my favorite thing to say is how long does a restaurant have to file a 941X form before they can go back and claim the credit? Because I think there's a really long timeline that people need to be aware of.
Right. Well, if you want me to jump in on that, the second question first, you can file the 941X as long as it's within the statute of limitations period. So generally up to a 3-year period, you could go back and file it. But the first part of your question is really about cash flow. So presumably any employer, restaurant business that is eligible for the credit, presumably they would want to file as quickly as possible. The timing does vary. The IRS I will tell you, is overloaded right now. 941Xs have begun to be processed, and payments will be made. How quickly, we would need to go back and have further conversations with our colleagues there, but they are aware that they need to focus on getting the payments out as expeditiously as possible for the filings on 941X. The advance payments that are filed on the Form 7200, as a general rule, those come within several weeks. So The timing does vary, but I would encourage any employer who is eligible to credit not to wait for the full period of time to file the 941X, because it may just get lost in the shuffle. But the IRS is aware of the need, the liquidity needs that small businesses have, and we have been working and talking with the IRS to process the filings as expeditiously as possible.
And just to highlight that quickly, Aaron, I know we're running over time, but you can keep all of your federal tax deposits, your employment taxes, to retain the credit to help with cash flow. So you don't have to wait till you file the Form 941 and get a refund after the end of the quarter. In fact, it's far preferable that you not deposit the amount of the credit that you are entitled to each payroll period, and instead retain those funds. So for example, if you had, let's say you were a small employer and you had $100,000 in qualified wages during the period, payroll period, and your credit was equal to $70,000, you would retain as much of that as you could from your payroll tax deposit. So that includes your federal income tax withholding, your employee share of FICA taxes, and your employer share of FICA taxes. And that's much more real time than waiting for a 941 to be processed and a refund issued. The other thing I wanted to highlight quickly, because I've just seen a lot of questions that indicate there's some confusion on this point. The 500 employee threshold or full-time employee threshold, or the 100 full-time employee threshold last year, does not affect your ability to be eligible for the credit. It only affects the amount of the credit that you're eligible for. Employers of all size can be eligible for the credit if they satisfy either the significant decline in gross receipts or the governmental order standards. The small employers are just able to claim the credit with respect to wages paid to all their employees, while the large employers can only claim it with respect to amounts paid without respect to the performance of services, which is a mouthful in the statute that I use intentionally. I think so, unless there's anything else, Aaron.
No, that's it. I'm just going to try to wrap it up with three huge takeaways. One, there's a tax credit available for small businesses providing time to their people to get a COVID-19 vaccine. That's probably the fastest way to get back to normal. So let's make sure that we're aware of that new credit that Tom led off with. The employee retention tax credit, if you're not familiar with it, we're so grateful that Helen and Mike and Tom can provide this information for everyone. This recording will be available for folks on our website. We also have an updated fact sheet that people can review with their accountants. And Helen mentioned potential new guidance on ERTC. We talked about tipped wages. As soon as we get that information, you on this call, members of the National Restaurant Association, our state restaurant association partners, will get that information, because that's really big. So thank you again so much to Tom and Helen for joining us this afternoon. And it was a pleasure. Please get in touch with us if you're not already in touch with us on this issue and anything else that we can help with. Thank you again for everyone's time.